has not been great for the market. Most of us are seeing losses in our portfolio and recovery just doesn't seem to happen. But what's next? Is recession near? What to do now? What is the best course of action to do now? You will get the answer to all these questions in this video. So first of all, we need to understand what is happening in the market. In order to curb rising inflation in the US, Federal Reserve has raised the interest rates the 7th consecutive time, as a result of which RBI has to raise its repo rate in order to maintain the balance of trade. So what happens when the interest rate rises? So as the interest rate rises, as consumer, first of all, our consumption pattern changes. So now we will reduce consumption and we'll reduce our spending because of the higher cost of funds. We will even delay our spendings. And investors are now finding FD lucrative than the stock market. Even FPIs would not want to invest in India when US bond yield is rising continuously. All these factors are ultimately pushing the market down. So the question is, what's next? What to do now? See, the repo rate is already at 6.5% now. If you look into the trend, repo rates have increased from 4% in April 2022 to 6.5% in February 2023. We expect this market interest rate cycle to reverse in next 6 months and in the same pace as it went up. So as a result of which, we expect foreign portfolio investors to bring in funds as even they intend to beat inflation. With an expected GDP growth of 6 to 7%, the FPI money is going to be treated best in India. And what other option do they have? There are political conflicts with China, European economy is showing degrowth, and in other developing countries like in Africa, there are many political instabilities. The next reason why we have positive outlook for the market is that when you look into the companies, you will realize that share prices of stocks have erased by 40 to 50% with just 10 to 15% fall in revenue. So when you look into the companies, you will realize that share prices are impacted way more than the fundamentals. Apart from that, companies are continuously announcing capex plans, which is again making us very optimistic about recovery. There are no obstructions or indefinite delays. And announcing capex also means that companies are already operating at 80 to 85% of capacity. If we talk about other economic indicators, power consumption is on continuous rise. In fact, government has asked power plants to operate on full capacity. If we look into other indicators, India's Purchase Managers Index is way above key level of 50 consistently. Do you know what does it mean? Wait, let me explain you with the help of this graph. Suppose X-axis represent market valuation and Y-axis represent the future outlook. We are saying that we are very positive about the future outlook and we think that market is undervalued as of now, representing an opportunity to buy. So it is not the situation to panic. We will be concerned when valuations are already high but future outlook is not very promising. And lastly, to answer the question, this is the time that we strongly advise to stay invested. We are facing the last leg of pain. We may or may not face any corrections in the future, but we are definitely going to see recovery in the next 6 months. You look at it yourself. Even you will find clear indications of recovery. So going forward, we suggest you to stay invested. In fact, average out your cost in the next couple of months. We would also say that this is the worst time to exit the market. Because even if you invest in FDs, FD will give you 7% returns and post-tax returns would not even beat inflation and you will end up losing money anyway. And thus, we still believe that stock market is the best place to park your money.